Thank you so much for tuning in to Navigating Through Uncertainty. And yes, uncertainty is the name of the game currently. The question is, how do people and experienced people who've been in this markets and have seen number of cycles are thinking about this current landscape and navigating through it? Those are the set of questions that we're going to pose today to a very special guest, Mr. Mark Mobius, founder of Mobius Capital Partners, but really a veteran of the investing world and particularly in the emerging market space for a long time now. Mark, great having you. Thank you for joining in. I hope all is well.
Yeah, thank you. It's a pleasure being here.
Yep, the pleasure is actually ours. Mark, can you tell us whether this seems different to you than some of the other past cycles that you may have seen?
Well, you know, someone once said that the most expensive words in the world are "this time it's different." And I would say it's true case that we have now, that it's really not different, but every bear market, every bull market has different characteristics. The behavior may be similar, but there certainly are different characteristics that we've got to keep in mind. In this particular crisis we're facing, we not only have an incredible increase of money supply, but that's combined with a new currency, the cryptocurrencies, and the crash of these currencies is having an impact on the markets in general. So this is something that's quite different and unique than what we've seen in previous times.
Interesting. If we just take into account the last 15 years, is the tightening of the money supply and higher inflation, especially for the Western world, also a materially different factor? And therefore, could the market reaction be materially different than what we may have seen in 2013 or 2018?
Well, what we've seen in the past, of course, is when the Fed raised interest rates dramatically in order to fight inflation, it had a negative impact on the economies. But if you look carefully, by the way, at the behavior of markets, markets have not really been that much affected by higher interest rates. If you look at times when we've had bull markets, very often interest rates were going up. So it's not only interest rates that we have to look at, but we have to look at other factors like the tightening of money supply. You must remember, we're coming out of an incredible growth of money supply. The Fed last year increased money by over 30%. But that's not counting the cryptocurrencies, and no one knows what the size of the cryptocurrency market is. I just read somewhere that there are over 1,000 different cryptocurrencies. So that adds another area of uncertainty as to what exactly is out there. And when you see the cryptocurrencies shrinking, and when you see at the same time the Fed pulling back on money supply, of course, that has a big impact on the market.
Yeah. So Mark, what is your base case? Is your base case that the West and US hits a recession? And if so, what's the kind of impact that you envisage on the EM pack?
Well, the base case is, yes, there will be a recession because of the higher commodity prices. You must remember the Ukraine situation has put pressure in a number of areas, most importantly, of course, energy, but also food. Ukraine and Russia are big producers of wheat, and that's having an impact. So you're seeing these commodity prices going up, and that is having an impact on what people have to spend. And that means that you have a recession coming as a result of these higher prices. But you must remember, a recession does not necessarily mean that you don't have an opportunity to make money, because there are companies, even in this bear market, that are doing quite well. For example, some of the defense industries in America are doing fine because of the situation in Ukraine.
Yeah, and I was going to come for your view on the micros in just a moment, but just before that, so if indeed you believe that the base case is recession, Mark, what's the impact or the further impact that you envisage on the EM pack and the Asia pack? Because there has been a bit of a corrective move into some of those, into most of the markets from the recent highs.
Yeah, you must remember that the U.S. is still the largest economy, along with China. Everybody debates which is bigger, America and China, but America, United States has a much bigger impact because the U.S. is a major importer. They're not such a great exporter, but a major importer, and they import from all over the world. So a recession in America would mean a pullback in exports from other parts of the world, and of course that will affect those economies.
Okay, and is that already baked in some fashion into the prices, or do you reckon that there is more way to go?
It has been already reflected in some prices. If you look at the different markets, NASDAQ, which is the tech market in America, is down more than 30%. S&P, which is the more traditional companies, is about what, 21% now, around that area. So it depends on where you are. Of course, Bitcoin is down 70% or whatever.
Yeah.
So we have got probably more to go on the main markets in S&P and other markets around the world. We probably have more. So we're probably heading into the 30% area, generally speaking, and that puts us into what is defined as a bear market.
Most certainly. So what about markets like India, Mark? Because we've corrected about 20% and some of the other Asian markets would have been about 24% as well. Yeah. The tape is particularly bad too. Do you reckon more downsides ahead?
Yeah, I think there probably will be more downside on the margin. The good news about India is that many companies are still doing very well, and the economy will continue to do well. The economy in India is not so much impacted by what's happening in America. And there are other factors at work. For example, India, with its trade with Russia, will be getting enough oil, maybe at a lower price than what they normally would pay. And that will help the Indian economy. So in some ways, India is in a kind of a sweet spot, let's put it that way.
Okay. So there are factors working. I mean, if you look at the tax collections in India, they're looking very impressive. God willing, if the monsoons are okay, then that will be one more worry out of the way, though it doesn't look like that way. And the fact that you mentioned about oil and coal as well. So that versus the fact that MSCI India is trading at a much steeper premium to MSCI EM, which it usually does, but it's still at a higher valuation. And there is a recession in the West as your base case. So do you reckon that it could be a sideways market with a downward bias, or do you think most of the negatives are in the price?
By the way, I don't look so much at the price earnings ratio as a measure of value.
Okay.
Because it's more of a backward-looking measure. What I like to look at is the return on capital. In other words, what is the yield on capital that Indian companies are producing? And you'll find that they're doing very well in that respect. So a company, for example, that has a 20 or 30% return on assets or return on capital, and a company that has no debt is going to do very, very well in India because they're in a growing market. It's a young market, and they have an incredible room to grow. They don't have to go overseas. They have enough growth in their own country.
Got it. Mark, the other bit is typical in a bear market scenario is the fact that when markets get oversold and the sentiment gets really bad, then there are some sharp bounces as well. There are a lot of people making a case for a sharp bounce after recent correction moves that we've had. Are you thinking that could be a case at all?
It's possible, but usually in this kind of scenario, you get the hopes and fears combined. In other words, you get optimists who say, "Oh, it'll be over soon. It'll come back," and then the pessimists who say, "No, it's going to continue down." But usually, the best way to look at it is the old saying, the trend is your friend. The trend is down. So you've got to assume that this trend will continue unless something really dramatic changes. And I don't see that in the works yet. And usually in this kind of environment, the bear market ends when everybody sort of throws in the towel. You know the term in a boxing match when the coach throws a towel in the ring, means it's over, and they don't want to fight anymore. And I think that we haven't reached that point yet, but we will. And when we reach that point, then there'll be a wonderful opportunity to buy.
There was an interesting Credit Suisse note that I read, Mark, which said that in the past, markets have only bottomed out during a full-blown recession and never before the recession. Does that tie in with your thesis that there is some more downside for markets to go?
Yeah, that probably is a good way to look at it. In other words, if you're heading into recession, and if the economy is getting bad, then the market is probably going to follow, or going to lead it actually. And when that happens, then you hit the bottom.
Yeah, viewers, remember, right now you're talking about the US markets, but if the US markets go down, it's very difficult for the other markets to not kind of defy that and not move along with it, which is why I asked the question, just so that there's no confusion.
Yes.
Yeah, Mark, a couple of other factors which kind of confound a lot of people. Would love to understand your view. There is an overarching belief that there will be earnings downgrades almost across, specifically for India as well, starting Q1 and Q2. And at the same time, there is this confusion around that if there is a resolution to the Russia-Ukraine conflict, and if China opens up and oil were to come off a little bit, that will be a material positive for India as well. So conflicting factors at play here. If both of them play out at the same time, what do you think the markets will look forward to the more?
Well, there's no question an end to the Ukraine conflict will mean a big change in commodity prices for oil. That's number one. That'd be very positive. Because we must remember, the American economy runs on oil. People, consumers in America, what do they look at? They look at how much they're paying for gasoline. And now it's running at, what, $5 a gallon. This is very, very high for many households who depend on their car to go to work, to bring the kids to school, so forth and so on. So this is a very, very important indicator. If the Ukraine war ends, then we've got a completely different situation. But the recovery would take time because all the sanctions and all the rest of it would take time, maybe a half a year or so forth. But I don't think that's going to happen because the Russians are determined to continue, and the Ukrainians continue to fight back with the aid, a lot of aid from the US and Europe. So I don't see that happening anytime soon.
Okay, so last couple of questions, Mark. Considering that your thesis is that the conflict may not necessarily see a real-time, near-time resolution, though I'm sure you and I both hope that it does, but logically it doesn't do that. Oil prices stay slightly elevated, and we have a factor which we haven't seen for the last 10-12 years, which you alluded to, which is quantitative tightening, which we have never seen in the last few, as opposed to maybe before 2008. How does that therefore have an impact? Does it have a swift impact on markets, or will the markets take time to digest it?
Well, there's no question. The anticipation, of course, is very important, because if people see that money is being contracted, they take action. In other words, they stop buying, they reduce their spending behavior. And of course, that impacts earnings of companies and expectations of earnings. But more importantly now is the interest rate situation, because the Fed is looking at the inflation rate at 8.5%, and they're saying, look, our rule book says we've got to raise rates above the inflation rate, which means 9%. So everybody was shocked with a 0.75% increase recently. I wasn't shocked at all. They're looking at the playbook, and they have to move quickly. They're way behind the 8 ball, in the sense that they should have acted sooner if they wanted to get those rates up and hit the inflation rate. So I think we can expect more pain in that direction.
Got it. Last topic, and that's India micro, Mark. You spoke about maybe US defense companies doing well. I think India is no different. We've had a fairly good run for the defense names, but I've heard you in the past say a number of times that you like selectively India small caps, and everybody's against small cap investing currently. I've heard you speak about some fairly interesting, promising themes in India too. What is your India view?
Uh, we focus on companies, not necessarily small, the definition of small cap, medium cap differs all over the world. A company in America that has a market capitalization of 50 billion may be considered medium cap, whereas in India would be considered large cap, whatever. But what we do is we focus on companies that are not being noticed. In other words, companies that may be not in the index, companies that are not being really fully researched by brokers and research organizations. Those are the kinds of companies we're interested in because that gives us a little bit of an edge in the sense that we do our homework, we look at the company in detail, and then we can make a decision based on that research while other people are not noticing. That's what really interests. So that means, of course, we would tend to get into the medium cap, I would say. I wouldn't say small cap because small cap gets you into very illiquid companies, which
Sure.
is dangerous if you're running an open-ended fund.
Okay, so I know you look at a lot of things, so you may not have everything at the top of your mind, but any thoughts about what within India looks promising? Not specific names necessarily, but thematically, if at all.
Well, I think thematically, you've got to look at software companies because India, of course, is a leader in software around the world, and they're expanding not only for export but for domestic use. So, the moves that the Modi government have made to digitize the entire economy have been quite amazing, and that is going to have ramifications all over the country, and that means there's going to be more and more need for software. But the other area I'm interested in is hardware. In other words, as manufacturers begin to diversify away from China, India is a logical place for companies like Apple to be. So I believe there'll be more opportunities for manufacturing in India, manufacturing technology.
Okay, I still have 1 minute left from my allocated time, Mark. Can I ask you what within this whole China plus one system do you find India materially benefiting? I know you mentioned the hardware part, but beyond that, a lot of people talk about India's core expertise in auto parts, in chemicals, in pharmaceuticals, and now the PLI schemes are giving benefit to a bunch of other manufacturing items as well. Have you tangibly seen evidence of companies that you talk to wanting to move supply chains out of China into India? Where are these themes that they are focusing on?
Yes, I've seen that, and it's not only in necessarily in tech, but tech, I believe, is going to be the area that's going to probably grow the fastest. But other areas like garments, textiles in general, there are, of course, already many good exporters in India, but that area is going to be growing. And all kinds of consumer goods, whether it be toys, kitchen utensils, you name it. You see, the beauty of the Indian market is that it's a huge market in itself.
Sure.
So that a manufacturer in India can produce for the Indian market and produce in huge quantities and then export with no problem at all, So that is, I think, great opportunity.
Great. Mark Mobius, it's always a pleasure talking to you, but more so during these uncertain times. Thank you so much for your time.
Thank you. It's a pleasure.
Yeah, it was a pleasure. And viewers, thanks for tuning in.